Have you ever looked at a stock and wondered, why are there so many people betting against this company? Or maybe you've seen crazy headlines like 10 billions lost in one day after short squeeze meltdown. That's not some movie script, that's Wall Street in real life. And it all comes down to one key thing most beginner investors ignore, and that is short interest. Hey everyone, welcome back to the channel. I'm Ray, and this is Revolution, where we dive deep into the markets with bold thinking, smart investing, and sometimes a healthy dose of rebellion. Today, we are going to talk about something most investors never fully understand, yet it plays a massive role in how stocks move. It's not chart pattern, it's not some secret indicator, it's short interest. And it can tell you who's betting against a stock, how much pressure is building behind the scenes, just like the current underneath the ocean, and where you as an investor should tread carefully or lean in with confidence. So buckle up because by the end of the video, you understand what short interest really is, how short selling works, how it can blow up in people's faces, and ultimately how you can use it to make smarter investing decisions. Let's jump in. Short interest is the percentage of a company's shares that are currently being shorted. In other words, it shows how many people are actively betting against that company's stock. Here's what's happening behind the scenes. People borrow shares they don't own, typically from a brokerage. Then they sell those shares at the current price, hoping the price will drop. Then they buy them back cheaper, return them to the broker, and keep the difference. For example, you borrow one share of Apple stock at $100. You sell it instantly, the price dropped to $60. You cover, that's the terminology for buying back the shares. You return the share and make the $40 profit. It sounds smart, right? But what if the stock price rises instead of falling? This is where it gets dangerous. If the stock you shorted starts going up, you're losing money. You still have to buy the stock back eventually, but now at a higher price. So going back to the same example, Apple goes from $100 to $150 instead of dropping to $60. Now, you're buying back higher and losing $50 for that share you bought. Here's the thing, it can get even worse because there's no limit to how high a stock can go. And what happened to your losses? They can be unlimited. Imagine that your one Apple share at $100, it goes to $1,000. So you're now down $900 just on that one share. What if it goes to 10,000? Now you're down 9,900 bucks. So do you guys see how this can get really ugly very fast if everything lines up in the wrong way if you're betting against a company? And that's what happened with GameStop, AMC, many other companies, Beyond Meat, that has short squeezed before. Too many people were shorting these stocks. Retail investors caught the wind, and when the price started rising, short sellers panic. They're forced to buy back at a much higher price, and that forced the stock of the company to push even higher. And because of that, many people who bet against those company, they incur huge amount of losses. In fact, there are certain institutions that lost billions of dollars because of that. And at the same time, some people walk away with life-changing gains. And of course, one of the people we know is the famous Roaring Kitty. Moving on, here's the real question. Why should you care about short interests as an investor? Because short interest is a signal. It reveals what the market thinks is going to happen or what they are afraid might happen. When there is a high short interest, it means that there is a lot of negative sentiment. Investors think the stock is weak, overvalued, or heading for trouble. On the other hand, low short interest means market confidence. Investors trust the company, investors trust the fundamental and financial of the company. And here's a really cool statistic if you look it up. Most strong, profitable companies have short interest under 2%. So if you were to go into Yahoo Finance and look up Apple, AMD, Nvidia, Google, go to short interest. It will take some searching. The data is there. All their short interests are under 2%. It's crazy, isn't it? That means the market doesn't see much downside. And most investors, institutions are betting for it to go higher. So if you're investing long term, that number can give you a peace of mind. And if you're looking for a contrarian play, high short interest stocks might offer explosive upside if or when the bears are wrong. And the final point is that short interest is not a crystal ball, but it's a weapon in your investing toolkit. Now you know what short interest really is and why it absolutely matters in your investing journey. Don't just follow the price, the indicators, understand the pressure behind the scenes. Because when you know where the big bets are, you can make smarter moves and decisions. So if you found this video valuable, smash that like button, subscribe, comment, share your thoughts with me. And thank you today for your time. And thanks for watching. I'll see you in the next one.